Hello, my name is Carlos McWhorter, and today we have a stock analysis of Servicenow. So Servicenow is a cloud-based solutions platform for different businesses and enterprises to help streamline workflows. So they are AI-powered and one of the early adopters of using AI as far as American businesses are concerned as their primary product in servicing their customers. So we're going to get into their fundamentals to see if this is a quality business, and then we're going to take a peek at their valuation to see if we believe this company is undervalued, overvalued, or fairly valued. So let's get into Servicenow and a quick definition, because a lot of people aren't familiar with this type of business. So looking at their 10K, their financial statement, it says that they are a cloud-based solution that helps enterprises and organizations across public and private sectors digitize workflows in line with purpose of making the world work better for everyone. So that is their goal and their purpose. So just to give you a little bit of background, they have some pretty significant customers. So they service the Department of Defense, Walmart, Amazon, United Health Group, Scripps Health, Honor Health, Apple, Howmet Aerospace, CVS, Delta, NASA, Microsoft, and Deloitte Consulting. So they do have some heavy hitters as far as their customers. And another thing I found out looking through their financial statements, they have a 98% retention rate. So a very high rate of return as far as getting customers and keeping those major customers. So they do have some runway and a lot of a great foundation that they're building on. But just look at this company and look at the stage that they're in, look at their revenues and cash flows, balance sheet, and look at their performance to see if we believe this is a quality business or not. So let's get into their 5-year chart. Looking at their 5-year chart, we see that they have had pretty significant gains since 2022. So in a strong uptrend, potentially in a downtrend here, but overall strong uptrend for the past few years. We have a technology company, a tech company that has a beta of 1, which means it moves as the market moves. It's not overly sensitive. Companies with a high beta, 1.5 or more, we understand that there's a lot of volatility here, but this is a tech company that is not showing a ton of volatility. A PE ratio of 144, almost 145. So that's pretty high. That's saying that this company, based on their earnings, is very expensive. This company right now has a market cap of $203 billion. So let's take a look at the fundamentals of this business. First, we look at the segments of the business because we have to understand where the data is coming from. So looking at the revenue segments, we have about 89% coming from their SaaS. That means their software as a service, their subscription services to their clients, about 89%, and the 11% is from their services, what they call their services. So these are not ongoing subscription services, but these are more implementation services or any type of consulting that they do. So they are a SaaS company, 89%, and a small percentage of their services. So let's look at their revenue trends. So this is a company that's, again, in their early stages pretty much. And we see that they are still in a high growth state, above 20% for the past 5 years, 32% for the past 10 years. So $1 billion all the way up to 10.9 billion in 2024. Solid revenue growth as we see 47 and 38, and we see it starting to slow down. That as a company matures and as they begin to become more established, that is normal. So that looks pretty good there. Gross profit. What I love about this, 67% all the way up to 79% gross margins. That is amazing. That means for every dollar that they make, they're keeping about 80 cents once they cover the cost of their product. So that is great, amazing margins. Even for a software company, that is an amazing, a great margin and solid growth in that margin. So awesome to see there. Going to profitability, looking at their net income, we see that from 2015 to 2016, they were at a loss. Steady growth, a monstrous year here in 2023. And it looks like they're down 17% from last year as far as their profit. So looks like we'll see in their cash flow statement that I think they're spending a lot of money as far as capital expenditures and continue to build their product, which is fine. So that's why they have a loss here. But we see that they have solid growth going all the way up to 1.4 million right now in net profit. So that looks good. Looking at their free cash flow. Looking at their free cash flow. Similar story, 226 million all the way to 3.4 billion in 2024. Again, solid growth here. We have cash flow growing at 20% for 5 years, 17% for the past 3 years. So not as high as the revenues. However, I believe that is because of the capital investment that they're doing, continuing to grow that. They're spending a lot of money continuing to build their product, which they should as a business in their early stages. So the capital allocation is making sense from that standpoint. So let's take a quick look at their balance sheet. They keep their debt pretty low compared to their cash flow. As you see, they only have 1 year right here, 2016, where the cash flow, or I would say they were over leveraged with 16 years times free cash flow, meaning they would take 16 years to pay off their debt based on that year. But as you see, they always stay under 3 years, and 23 and 24 under 1 year of being able to pay off their debt. So they are leveraged, or I say they are in a great leverage position with free cash flow much higher than the debt over the past few years. So the balance sheet looks solid. So this is the only thing that I don't like right now is the shares outstanding are steady growing. Now, as we just saw, their debt balance is pretty low. So it makes sense for a new company. Here's what I'm thinking about their capital allocation, or as far as their shares policy, they are bringing in cash by selling shares, and they are using that cash to continue to build their business. One thing I will say, they are growing the company. The company is growing faster at a much faster rate than their share dilution. So as a shareholder, yes, you are being diluted with this practice of selling shares. However, the company is using that capital to continue to build the business, and the business itself is growing at a faster rate. So as a shareholder, you're not really losing by this company selling shares, but we want to point that out. We always look at this. They are selling shares, but as a shareholder, they are growing your value at a much faster rate than you are being diluted with these shares being sold. However, this is not a practice that I think is going to continue to go for a long time, as this company is continuing to grow their cash flow and their revenues are pretty rapidly, as we've seen. So I don't believe this is the practice that will continue for a very long time, as the company is getting to, as we see, growing those cash flows consistently. So they will have enough cash from their cash flow from their business, So they will have enough cash from their business to use for capital expenditures or whatever they please. And they will likely begin to start buying shares or repurchasing them and giving value back to the shareholder. Economic value added. So for a newer business, this is not the best metrics to look at. So looking at their software and IT services, there are other businesses that are in the same space as them, not necessarily their rivals or their competitors, but companies that are in the same space doing the same thing with their software. They have a return on capital of 23% on average, with a weighted average cost of capital of 9%. So we're looking at about 13.28% of value creation each year from these firms. Servicenow is not there yet. However, they are in the positive right now, and they are projected for at least the next 20 years continue to earn returns on capital much higher than their weighted average cost of capital. So this will improve, but just right now, this is where they are. So they are creating some value, but not a whole lot at the moment. So as far as their capital compared to their returns, but that's going to continue to grow and improve over time. So with that said, looking at their valuation, I want you to understand something. There's a difference between there's a difference between price and value. Okay, so imagine this. I can get a Coach bag for $300. I can get a Louis bag for $3,000. It doesn't mean that the Louis bag is 10 times better than the Coach bag. It's just the price that is put on that bag. So it's not like I can wear that bag 10 times more or use it 10 times more, get greater use out of it. It might be 3 times better, it might be 5 times better, but we know it's not 10 times better as far as the quality. So value and price are not always aligned. And we have to keep that in mind when we're looking at stocks. So as far as this company, I don't see anything wrong with the business model. I don't see anything, this is a very quality business. I do like the business. However, that doesn't mean the price currently is something that I like, especially as somebody who looks for deep value, who is a value investor through and through. So let's look at what I think about this price. So I project, or the company is projected to grow at about 20% for the next 3 to 5 years. Looking at their weighted average cost of capital for the past 5 years, 6.8%. A quality tech company, I think 25 times free cash flow is a respectable expected terminal value that I can expect to get if I were to sell the stock in 5 years. I think I can sell it at about 25 times free cash flow or more. With that said, I still think the business is overvalued. Right now, it's at $986 per share. I think the range is between $598 and $731 as far as the fair value. So we're looking at a 32% downside based on my assessment. Now, this is just how I like to look at valuation. I like to use my discount cash flows, throw in my assumptions, and see where it is. Now, one thing I will say, Morningstar has the fair value currently at $990. So according to Morningstar, they believe this stock is fairly valued or just undervalued. So you have to use your own assumptions and what you're thinking about the business. And some of the things that has me kind of a little hesitant to value it that high. So this company started as an IT service company. So they kind of focus on IT departments within businesses and improving those workflows. They started to branch out. Now they do HR, they do operations, they do finance. So as they begin to branch out, they're going to face more competition, such as Salesforce and these other big monster companies who are successful CRM companies. So what can this company do that Salesforce can't? If this company is going to start breaking into other departments and serving those other departments and not just kind of stay focused on HR and IT, then this technology that they're using, I believe a company like Salesforce can develop their own technology and use that and then kind of ward off the competition. Now, I understand when it comes to switching cost, I believe that they are strong with their current customers, and it's going to take a lot for a customer to leave this service and go to another service. This is why when you pick these companies to be integrated into your business, you have to make the right choice. It takes too long to choose another software, keep both systems operating as you're transitioning data. It's just a lot of money involved. So companies really don't like to they don't like to switch these companies once they get them integrated. With that said, I believe Servicenow is strong with their customer base and continue to grow there. I just don't see them becoming a company that will eventually compete with a Salesforce or SAP or Oracle. So that's why I am hesitant. Other people may feel differently, and that's totally fine, but that's just the background behind my valuation. So I see them again, $598, $731. Great business, I believe, quality business. If you got in much earlier than where they are now, I think you're in good shape. It's definitely a hold. If you are looking to get in, I would be wary at this price, unless you're dollar cost averaging and you're just going to keep investing a small amount per paycheck or per month, then the valuation doesn't matter. Just keep investing. Definitely a company for you value investors. Definitely one I think should be on your watch list and continue to pay attention to what they do. Now, this stock does take a dive. I think it's going to be a buy. So that's my assessment of this business. Let me know what you think in the comments, and also give me a few suggestions on some other companies you would like for me to value and give you my input on. Hope you enjoyed this video, and I hope to see you in the next video.